The vaults are empty, not running low, not in decline, empty. And the most powerful nation on earth has no idea what to do about it, because the people who drained those vaults did it slowly, patiently, and deliberately over 15 years, while Washington was looking somewhere else entirely. Here is the number that should stop you cold. COMEX, the exchange that sets the global price of silver for the entire world, currently holds less than 100 million registered ounces in its vaults. In 2021, that number was above 400 million, a 75% collapse in physical silver in less than 4 years. And at the exact same moment those American vaults have been draining, China has been pulling physical silver off Western exchanges at a pace not seen since the Hunt brothers nearly broke the entire silver market in 1980. The United States' strategic silver stockpile, which once held 6 billion ounces, 6 billion, now holds a number so small it is counted in millions. The metal is gone. And here is what you need to understand before anything else. This has happened before, not once, not twice. 3 separate times, across 500 years with 3 different empires, and every single time, the people living inside the system were the last ones to see it coming. Stay with me, because what I am about to show you is not a silver story. It is not even a China story. It is a pattern, a 4-stage pattern that every reserve currency empire in recorded history has followed without a single exception. And once you see it, once you can name each stage and recognize exactly where you are standing inside it right now, you will never read a financial headline the same way again. But before I show you the pattern, I need to ask you something directly. Do you have savings, a retirement account, bonds, dollar-denominated assets of any kind? Because if your answer is yes, then what I am about to show you is not abstract history. It is a map of the ground underneath your feet, and some of that ground is already gone. Let us start in the mountains of Bolivia, 1545. Spain has just discovered Potosi, the largest silver deposit ever found on Earth. At its peak, that single mountain produces 60% of the world's entire silver supply. Spain uses it to build the Spanish real, the first true global reserve currency. China accepts it, India accepts it, the Ottoman Empire accepts it. The Spanish real moves across every continent on Earth. This is what I call Stage 1, a monetary foundation built on something real, something finite, something that cannot be printed. Physical silver in the ground. It works perfectly. It always does in Stage 1. And that is precisely what makes what comes next so dangerous. Because power does something predictable when the money flows easily. It spends. Spain launches wars across Europe. The 80 Years' War against the Dutch. Campaigns against England, against France, against the Protestant Reformation. It builds an empire stretching from Peru to the Philippines. It makes promises to soldiers, to bankers, to the church. Every single promise requiring constant silver to stay alive. The Genoese banking system starts extending loans against future silver deliveries. Paper claims against silver begin to exceed the actual silver coming out of the ground. And here is the part that most people never learn in school. Spain spends an entire century experiencing what economists call the price revolution. 100 years of inflation caused directly by flooding the world with silver without any corresponding increase in real productivity. Prices across Europe rise by 600%. Spain is simultaneously the richest empire on Earth and quietly, systematically, going broke. This is Stage 2, expansion becoming overextension, the paper promise growing larger than the physical reality beneath it. You already know where this goes, but stay with me because the details matter. By the early 1600s, Potosi's best ore veins are exhausted. Output begins to fall. Spain's commitments do not fall with it. The Spanish crown defaults on its debts to the Genoese bankers in 1575, then 1596, then 1607, then 1627, then 1647, then 1653. 6 sovereign defaults in less than 80 years. Not 6 recessions, not 6 devaluations, 6 full collapses of sovereign credit. Each one followed by a fresh promise, a new restructuring, more paper claims against silver that never arrives. Meanwhile, the Dutch and the English stop routing their trade through Spain entirely and begin building their own monetary systems from scratch. Stage 3, the loss of control, has arrived. The physical reality and the paper promise are too far apart to hold together. And Stage 4, by 1700, Spain is no longer a monetary superpower, not from one catastrophic moment, not from one bad king or one lost war. The silver hollowed out silently beneath an architecture of promises that could no longer be honored. The coin still carried the crown's image. The vault behind it was empty. The pattern was complete. Now I want you to hold that image, the empty vault, the coin that still looks real, and move forward exactly 300 years. July 1944, Bretton Woods, New Hampshire. World War II is still raging. 44 Allied nations sit down at the Mount Washington Hotel and design the post-war monetary order from scratch. Every currency in the world pegged to the US dollar. Every dollar convertible to gold at exactly $35 per troy ounce. The United States holds 70% of the world's monetary gold. The foundation is physical, the math is clean. This is stage one of the modern dollar system, and it works brilliantly. Europe rebuilds. Global trade explodes. American consumers prosper on a scale no civilization in history has matched. So what does power do when the money flows easily? It spends. The Vietnam War, the Great Society, both financed simultaneously with dollars that exceed America's actual gold. By the early 1960s, a Belgian economist named Robert Triffin has already written down the exact equation for how this system destroys itself. If you are the reserve currency issuer, you must run deficits to supply the world with liquidity. But those deficits eventually make the world stop trusting your currency. They called it the Triffin dilemma. American economists and Treasury officials debated it in journals and in closed rooms throughout the entire decade of the 1960s. They understood the mathematics precisely, and they expanded the dollar supply anyway, because the political cost of stopping was higher than the deferred cost of continuing. It always is, in every empire, in every single cycle. Then comes stage 3. France under Charles de Gaulle stops trusting the promise. His economic advisor Jacques Rueff tells him the math does not work. France begins formally requesting gold in exchange for dollars. Other nations follow. America's gold stock, which stood above 20,000 metric tons in 1945, has fallen to 8,100 by 1971. The paper claims against that gold are enormous. The physical gold is disappearing. And on August 15, 1971, Richard Nixon goes on national television and announces what he calls a temporary suspension of dollar convertibility to gold. It was not temporary. Bretton Woods was finished. The foundation was gone. And the stage 4 that followed consumed the entire decade of the 1970s, stagflation so severe it broke the academic consensus on how economies work. Gold surged from $35 to $850 an ounce. Silver went from under $2 to $49.45. The entire commodity complex repriced to reveal what decades of paper promise accumulation actually looks like when the anchor is cut loose. Paul Volcker eventually stopped it by raising interest rates to 20%, breaking the economy and restoring dollar credibility through institutional will alone. But, and this is the point almost no analyst addresses honestly, Volcker did not solve the Triffin dilemma. He suppressed it. He bought another 50 years by refinancing the system on confidence rather than physical reality. The paper promises resumed. They grew bigger, faster, further from any physical anchor than before. That was 1980. And the can he kicked is now sitting directly in front of us. One more, and this one is perhaps the most important, because its ending looks exactly like what is beginning right now. Britain, 1820. The British gold standard is the most successful monetary system in the modern era. The pound sterling is the world reserve currency. London is the center of global finance. The Royal Navy enforces a trading order grounded entirely in gold convertibility. Every pound can theoretically be redeemed for a fixed weight of gold. The world trusts it completely. Stage 1, fully operational. Then World War I arrives. The cost, roughly $170 billion in 1913 dollars, translating to several trillion today, cannot be paid with gold-backed money. Britain suspends convertibility. Winston Churchill attempts to restore it in 1925 at the old pre-war exchange rate. John Maynard Keynes publishes a pamphlet the same year called The Economic Consequences of Mr. Churchill, warning publicly and in precise detail that restoring gold at the pre-war rate will crush British exports, force wage cuts across the entire economy, and devastate working people. Keynes is exactly right. Britain abandons gold in 1931, for the last time. What follows is not a cliff, it is a staircase. Sterling crises in 1947, 1949, 1956, 1967. By 1976, Britain is at the IMF window, borrowing from an institution it helped build. The empire that invented the modern global financial system ends that era asking that system for emergency credit. The reversion was not dramatic. It was inevitable. Slow, relentless, and indifferent to British pride. 3 empires, 3 physical foundations abandoned, 3 identical collapses. The mechanism is not theoretical. It is the most well-documented pattern in the history of money. Now apply it to today, step by step, and listen to how cleanly every stage confirms. After Nixon closes the gold window in 1971, Henry Kissinger spends the next 3 years constructing a replacement foundation. In 1973 and 1974, He negotiates a series of agreements with Saudi Arabia, American military protection, and guaranteed arms sales in exchange for one specific commitment. Saudi Arabia prices every barrel of oil in US dollars and recycles its revenues into US Treasury bonds. Every other OPEC nation follows. Every industrialized nation on earth needs oil. Every nation that needs oil now needs dollars. The foundation of the new system is not gold. It is oil, military enforcement, and geopolitical leverage. Stage 1 of the current cycle. Check. Stage 2 runs from 1971 to 2008. Global dollar-denominated debt grows from roughly $1 trillion to over $200 trillion. The United States exports dollars in exchange for Chinese goods, Japanese electronics, German machines, and the manufactured output of the entire developing world. Financial engineers create paper claims on paper claims, mortgage-backed securities, collateralized debt obligations, credit default swaps so complex that the people selling them cannot always explain what they contain. The U.S. national debt grows from $400 billion in 1971 to over $10 trillion by 2008. There is no physical constraint. The paper promises multiply without limit. Verified. Stage 3 is now, and I want you to feel each of these individually before we put them together. The U.S. national debt has crossed $36 trillion. Annual interest payments on that debt now exceed $1 trillion, more than the entire U.S. defense budget. America is spending more servicing the interest on what it owes than it spends on its military. The dollar's share of global reserves has dropped from 71% in 2000 to approximately 58% in 2024, the fastest rate of reserve diversification since sterling lost its dominance in the 1950s. The BRICS nations are accelerating bilateral trade in non-dollar currencies, and Saudi Arabia, the very linchpin of the petrodollar architecture that Kissinger built, signed a currency swap agreement with China in 2023 and began accepting yuan for oil. The foundation is not cracking. It is being deliberately, systematically dismantled by the people who built it alongside us. Undeniable. And then there is silver. COMEX registered inventory below 100 million ounces. Paper claims against that silver at ratios of up to 200 to 1. 200 paper ounces for every single physical ounce sitting in a vault. Think about what that actually means. If even a fraction of those paper claim holders demanded real delivery at the same time, there is not enough silver in the COMEX system to honor them. This is Bretton Woods arithmetic applied to a single commodity. The same gap, paper promise vastly exceeding physical reality, that ended Spain, ended Britain, and forced Nixon on television in 1971. And here is where it stops being a history lesson and becomes something that touches your life directly. You are almost certainly holding paper claims right now, your savings account, your retirement fund, your bonds. Every single one of those instruments is, at its core, a paper promise backed by institutional confidence, not by silver in a vault, not by gold in a depository, by trust. And the pattern has an unblemished 500-year record on what happens to paper promises when that trust breaks. Meanwhile, China is not confused about any of this. China's solar manufacturing alone consumes silver at a scale most Western analysts still underestimate. Each panel contains roughly 20 grams, and China is building solar infrastructure at a pace that makes every other nation look nearly stationary. But China's accumulation goes far beyond industrial demand. After watching the United States freeze $300 billion in Russian sovereign reserves overnight in 2022, using dollar infrastructure as a geopolitical weapon, China drew a conclusion that every rational state actor should have drawn in the same moment. Any asset held in dollar-denominated form is held at Washington's discretion. It can be frozen in an afternoon. It can be sanctioned before the markets open. Physical silver sitting in a Shanghai warehouse cannot be reached by a Treasury Department order. Physical gold cannot be deleted through SWIFT. China has been converting paper dollar claims into physical reality for 15 years. The pace is accelerating. The COMEX charts are showing you exactly where that silver is going. Check. Now here is the question you need to sit with. You watched Spain hollow out its silver vault across 6 sovereign defaults while writing promises it could never honor. You watched Nixon close the gold window the moment paper claims exceeded the physical gold available to redeem them. You watched Britain surrender its reserve currency status one sterling crisis at a time until it was at the IMF window with no options left. So what do you think happens when COMEX vaults are below 100 million ounces, paper claims run at 200 to 1, and the largest rival power on earth has been pulling physical silver off Western markets for a decade? And if you are already reaching for the argument that this time is different, stop. Because every empire inside this pattern made that same argument at exactly this stage. The Spanish court in 1600 pointed to unmatched naval power and a century of global dominance. The British Treasury in 1914 pointed to the pound's flawless track record and London's unrivaled infrastructure. American economists in 1971 pointed to industrial superiority and institutional depth. Every single one of those arguments was factually correct on the surface. Every single one was mathematically irrelevant to what was happening underneath. The most dangerous phrase in monetary history has always been three words: this time different. American exceptionalism does not suspend the Triffin dilemma. The U.S. military does not fill an empty COMEX vault. Quantitative easing, yield curve control, forward guidance, these tools do not eliminate the claims problem, they compound it. They add more paper to a system that is already carrying more promises than physical reality can honor. And the argument that artificial intelligence and technological productivity will outpace the debt burden, that misunderstands the mechanism entirely. This is not a productivity crisis. It is a claims crisis. There are more paper promises against physical reality than the physical reality can redeem. Technology does not manufacture silver from confidence. The pattern does not respond to optimism. It responds only to the ratio between what has been promised and what physically exists in the vault. And right now, that ratio is the most extreme it has ever been in the history of this monetary system. The vault is empty. The paper claims are staggering. The rival power is converting paper into physical reality as fast as logistics allow. And the pattern, the same one that hollowed out the Spanish Empire, forced Nixon onto television, and walked Britain to the IMF, is completing its final stage. The only question is whether you understand what is happening before stage 4 completes, or after. If you want to understand exactly how the machine was built, how Kissinger engineered the petrodollar system that kept dollar dominance alive for 50 years after Bretton Woods collapsed, and what the early days of stage 4 have looked like every single time this pattern has completed, that is the next video. It is already made. It is waiting for you. Subscribe now and turn the notification on, because stage 4 does not send a warning. It never has. It arrives the moment the gap between the paper promise and the physical reality becomes too wide for confidence alone to hold together. That moment is closer than most people realize. The silver vaults beneath New York City are already measuring the distance, and the number they are reporting right now is under 100 million ounces and falling.